Picture this, it's the first of the month. Your rent payment just cleared $1,800 gone in one swipe. You worked roughly 62 hours to earn that money, and in exchange you get to keep living somewhere for 30 more days. That's it. No equity, no asset, no slice of anything that will still be yours in 10 years. You just paid $1,800 to stand still. Now compare that to your landlord. They bought that building 8 years ago. Your rent check this month covers their mortgage payment, and whatever's left over is pure profit. Every single month you are working to build somebody else's wealth. And the terrifying part? Most people don't even feel it happening because the money just disappears in one transaction instead of 1,000 small ones. This isn't a spending problem, this is a structural leak, and today we're calling it what it actually is: the silent tax. Welcome to the Finance Desk, the channel where we dig into the invisible math that keeps hardworking people stuck. If you've ever looked at your bank account after paying rent and thought, where did all of that go and why do I have nothing to show for it? This video is for you. Hit subscribe if this resonates, because we're about to break down exactly how much wealth renting is quietly costing you and what to do about it. Here's the lie we've all absorbed: rent is just the cost of shelter, a fixed expense like electricity or groceries, something you pay and move on from. But that framing hides something economists have studied for decades: the concept of imputed rent. It's the idea that when you own a home, you're essentially paying rent to yourself. Every mortgage payment builds equity you keep. Every rent payment builds equity somebody else keeps. Same monthly outflow, completely different destination. Let's do the math, because the gap is bigger than most people think. Say you're paying $1,800 a month in rent. Over just 5 years, that's $108,000. Gone, not reduced, not converted into anything. Just spent like you set fire to it slowly, 1 month at a time. Now imagine that same $1,800 went toward a mortgage instead. A chunk of it, let's say $500 to $700 depending on your interest rate, goes to interest, which functions basically the same as rent. But the rest, maybe $1,100 a month, goes toward principal. That's forced savings. That's money that comes out of your paycheck and lands directly in your net worth. Over 5 years, that's over $60,000 sitting in home equity that belongs to you, not your landlord, you. But it gets worse than just the missed equity, because rent doesn't stay flat. Landlords raise it. The national average rent increase is somewhere between 3 and 5% a year, and in high-demand cities it's often higher. Your $1,800 rent becomes $1,890 next year, then $1,984, then $2,083. You're not just missing out on building equity, you're paying more every single year for the exact same square footage, the exact same walls, the exact same nothing-to-show-for-it outcome. Compare that to a fixed-rate mortgage. Your principal and interest payment locks in the day you sign. It does not go up in year 2, year 5, or year 20. While your renting friends' costs climb every year, yours literally stays the same while the asset underneath you appreciates. That's not a small edge, that's the entire game. And here's where the trap really tightens: the longer you rent, the harder buying becomes, because rent isn't just costing you the difference in equity. It's costing you the ability to save for a down payment at all. If half your income is going to rent in a high cost of living area, there's nothing left to set aside. So you keep renting because you can't save, and you can't save because you keep renting. That's not a personal failure. That's a closed loop, and a lot of people are trapped inside it without realizing it has a name. Now I know what some of you are thinking. Bobby, I mean, this is the Finance Desk. Renting isn't always the villain. Sometimes it's cheaper than owning, sometimes buying ties you down. And you're right, this isn't renting is always wrong. Renting makes sense if you're not staying somewhere long enough to recoup closing costs, or if home prices in your market are absurdly inflated relative to rent. The math doesn't always favor buying. But the mistake most renters make isn't that they rent, it's that they rent passively. They treat the gap between rent and a hypothetical mortgage payment as spending money instead of investment money. And that gap disappears into restaurants, subscriptions, and lifestyle creep instead of going anywhere that builds wealth. Here's the mindset shift that actually matters. If you're renting, you have to manufacture the forced savings that a mortgage would normally create for you, because nobody is going to do it automatically. Your landlord isn't building your future, you have to build it yourself on purpose every single month. Let's make this concrete. Say you're paying that same $1,800 rent, and you calculate that an equivalent mortgage in your market would put about $1,100 a month toward principal. That $1,100 is the number that matters. Every month before anything else, you move that amount, or even half of it if that's more realistic, into a separate investment account. Not a checking account where it evaporates. An account earmarked for a down payment or long-term investing. You're recreating, artificially, the forced equity that a mortgage would have given you automatically. Do that consistently and something interesting happens. Invested at even a conservative 7% return, $600 a month over 5 years grows to roughly $43,000. Over 10 years, it's closer to $104,000. You didn't need to own property to build wealth, you needed to stop letting the gap between what I could be saving and what I'm actually saving disappear into nothing. The renters who build wealth aren't the ones who avoid renting. They're the ones who refuse to let rent become their only monthly transaction. They treat their housing cost as one line item and their wealth building as a separate, non-negotiable line item, even while renting. That's the entire difference between renting and staying broke, and renting on your way to owning something eventually. Here's the thing that ties this all together. The silent tax isn't really about landlords or mortgages or even housing at all. It's about what happens to money that leaves your hands without a destination. Rent's just the biggest, most obvious example because it's often your largest monthly expense, and it produces zero return by design. But the lesson generalizes. Any dollar that leaves your account without building something for you is a dollar working for somebody else's future instead of yours. You can't always control whether you're renting or owning right now. Markets, credit scores, and life circumstances get in the way. But you can control whether the gap between what you're paying and what ownership would have cost you gets captured or gets lost. That gap is where your future down payment lives. That gap is where your compound interest starts. And the sooner you start treating it as sacred instead of spare change, the sooner renting stops being a trap and starts being a stepping stone. If this video helped you see your rent payment differently, subscribe to the Finance Desk, because we're going to keep uncovering the silent taxes hiding inside your everyday expenses, the ones nobody talks about but everybody pays. Thanks for watching, and I'll see you in the next one.